Well, I mean, you're not the only one who doesn't think we're in a recession. That was Bullard's point this morning, too. We're not in a recession right now, he said, and he points to the job market. You can't say we're in a recession now with the job market as strong as it is. But I want to talk about where you need to be then. If most of you, it sounds, are fairly positive on stocks, I want to talk about what Wolf Research put forth today. A shift back to the tightening trade is what they call it. It goes back to the point. You can say that the economy is as strong as it is, and that's totally great, and it's going to remain there. Nonetheless, if you believe all of the hawkish Fed speak, they're going to continue to raise rates. So you need to be on the right side of that boat, even if you think that the economy, the waters are smooth enough to keep sailing. They say stick back to that. Classic defensive. Healthcare, that's obviously done well, but that brings to mind the tech trade. Jimmy, that's where I want to go with you, yeah. Okay? ARK's been up a lot. It's up 40% from the May 12th intraday low. Mega caps have been carrying the water. They have been up a lot. Apple's up near 30% from its lows. Morgan Stanley today says no bottom for tech. We're on the wrong side of the profit cycle, and the reason the bounce is getting exhausted. Can the tech trade still work in a scenario of higher for longer and the Wolf Research tightening trade?
Yeah, it can work. You hear my tone? You hear my sort of, meh, yeah, it can work.
Yeah, but you sound like sarcastic.
Well, I don't mean it sarcastic. What I mean is more specifically, first off, good use of the word classic in front of the word defensive, because what's been going on here, people are tiptoeing back into this market and they think that tech is defensive. Tech is not defensive. You're thinking that because of the last cycle where it was a very low growth regime globally, economically, and that was the only place to get profit growth. Looking forward, I actually think that you're going to see profit growth above average outside of tech in the cyclicals. Now, that doesn't mean that tech is dead. It just means that at these multiples, you cannot reasonably expect the multiple expansion that you saw in the last cycle. So what that mathematically means is any share price gains in the Microsofts, Apples, Googles of the world is going to come from earnings per share growth. And that's going to be 8 to 10%. It's okay. I'm not being sarcastic, Scott. Sorry that it sounded that way.
Okay.
But it's just, I think you're going to get higher than average earnings per share growth in cyclicals and possibly multiple expansion.
Wow. Even in a slowing economic environment, cyclicals are going to outperform growth.
But you know my thesis, right? You disagree with it, which is fine, but you know my thesis.
I'm just questioning it.
Yeah, I'm answering it, right? Supply chain onshoring, infrastructure spending. What is that going to favor? Industrials, energy, materials, financials. Which, you know, by the way, financials, I mean, what's the average stock? JP Morgan, we were talking about last night, 9 times earnings, 3.5% dividend yield. What's Microsoft? 3 times that multiple. Like what okay. We lived in a regime for like 14 years where price didn't matter because money was free. Now money is not free. This is to Wolf's point. Like, these are not defensive. They may be good stocks. They may be fine, but they're not defensive at these multiples.
Joe, you want to take that on? I know you do.
I mean, first of all, the revenue growth from Microsoft, the buyback program from Microsoft, JP Morgan's not even in the right country when you try and make that comparison. So that just doesn't work. Sorry, Jimmy. But in addition to that, it's been clear that what the market has recognized over the last 6 weeks is that there's this potential moderation in inflation, that the Federal Reserve is going to continue to combat inflation itself, and that universally the speculators in the street was underweight growth. And if you were able to recognize that early, and you know, it's been one of my best trades so far this year in recognizing that early, in going out and buying CrowdStrike and buying NVIDIA at 149, in going out and buying the Qs. A lot of the trades that I have been done has been in recognition of that growth. Now, at some point, does it reach exhaustion? Yes, I think it ultimately does. But right now in the month of August, where every day is basically Sunday, and we're void once we get past the earnings of any real news headwinds, I think that you're going to see continued momentum on the upside, driven specifically by growth. Once we get to September, very clear, very obvious, you could get a little bit of a correction, but there's more to ride here in this growth story, and a lot of it is based on repositioning, Scott. Remember how underweight everyone was.
Yeah, and maybe are now. Kari, what do you think about this?
Yeah, well, the tech sector is down 17% year to date. Communications down 27%. I don't have my glasses on, but I think energy is up 30%. I mean, if we're talking about what's cyclical and what's defensive, what's worked or not, the tech trade hasn't worked at all this year. It's been underperforming for a year. And cyclical stocks and defensive stocks have done incredibly well. So if you compare multiples, if you look at Google, for example, and compare it to Brown-Forman, Coke, Pepsi, a lot of the, quote, defensive, steady, consumer staple names have multiples that are far in excess of what technology stocks that have solid earnings and sustainable growth. So, in my opinion, the winners have been cyclicals and defensive stocks this year. The losers have been on the tech side. And that's why this rally has been great for those stocks, because if we're not going to be in a severe recession, they are going to start to outperform, and their earnings are solid. It just, to me, has made sense. I mean, we've been arguing it for a while. It has not worked. But this pivot, which Joe referred to, in fact, has been to the benefit of these higher growth names, and it should be, because they've underperformed so much, and they showed in this quarter good growth.
All right, Degas, about tech. I mean, a lot of people think that, you know, this continuing rally hinges on tech, that forget about it. If tech starts to roll, if it gets exhausted, what's going to really carry the market any higher than it's already come to?
Well, Scott, you also have, because we talk a lot about the FANG, the major mega cap names, but there are other tech names that have growing earnings, Jim, out there that, for instance, Fortinet, Adobe, CDW, there's a lot of companies that have growing earnings in this environment that you can focus on. And so we're seeing that those tech companies can take a leadership. Obviously, we talked about healthcare. We talked about energy and materials. But we're also seeing these smaller than the mega caps technology companies can take a lead now in this market.